Hello again, everyone. John Flynn here from Flynn Real Estate in Niagara Falls, giving you some market updates for the 2022 housing market. And don't forget to like, subscribe, share. It helps out with future videos and getting this message out there. This week, as the title suggests, I'm going to focus on the stress test and, of course, interest rates again and this crazy market. So let's get into this. First off, I want to talk about the market. As many of you know, I'm in Southern Ontario, and I'll just bring up a quick graph here. This is from my board. I'm in the Niagara Association of Realtors, and kind of scary. Maybe some people like it. I think it's scary. We had the median price. If you look at this graph, it's crazy. This is 1 month from December 2021 to January 2022. I pulled this graph a few days ago, so all the data might not have been in there from January yet, but it is a big representative sample for the whole Niagara region and all sales. So you can see our median price, and I use median because it's the first thing that actually comes up when we pull our stats, but the average price is 12.2%. The median was 14.2. So we went from around 750,000 in the Niagara region for the average residential sale price to 850,000. And yeah, that's pretty insane. So a 14.2% median increase in 1 month, or 12.2% average increase. It's approximately $100,000 people's homes went up in 1 month. Like that's pretty crazy and pretty scary at the same time. Yeah, you've watched my other videos, you know why I think this happened. Obviously, this is to do with inflation and interest rates. But let's get into now the Bank of Canada. So the Bank of Canada did their first announcement on January 26th. And for those of you who followed, they didn't change the interest rates. It's still at 0.25%. And for the overnight lending rate for the Bank of Canada. And of course, you know, there's promises of interest rates to come, or interest rate hikes to come, but they haven't happened yet. So I just want to get into his, and I say his, Tiff Macklem, the governor of the Bank of Canada, his statement, his opening statement regarding this. And I have it here. I have a couple of screenshots where I've copied and did some screenshots and highlighted some things. But there's 3 points, threefold he puts it. There's 3 points he wants to make for the January 26th announcement, which was, again, no change. He talks about the first point: the emergency monetary measure needed to support the economy through the pandemic are no longer required, and they have ended. So, okay, that's great. They've ended. The second was the interest rates will need to increase to control inflation. Canadians should expect a rising path for interest rates. So, again, very basic information, like I've talked about before, and many of you know, pretty much the only thing that's going to control inflation at this time is the rising interest rates, which, again, didn't happen this time, but promises of them. And third, while reopening our economy after repeated waves of COVID-19, pandemic is complicated, Canadians can be confident that the Bank of Canada will control inflation. We are committed to bringing inflation back to target. So he's very committed to bringing the inflation back to target, which is 2% or so. And of course, the pandemic's to blame. And that's another thing. So he blames in this. If you read through it, I'm not going to go through the whole thing, but he talks about, of course, the pandemic, Omicron variant, supply chain issues, global supply chain issues, and whatnot for inflation. I personally think that they play a role, but I think the biggest thing with inflation is the interest rates, which he alludes to in the beginning, but he likes to blame everything else. I have theories for why he didn't raise the interest rates yet either, or also. So there was twice the housing was mentioned in this news release, or the opening statement, and I have these highlighted here. So he's just reassuring Canadians that they will control inflation. Prices for many goods and services are rising quickly, well, obviously, and it's making it harder for Canadians to make ends meet, particularly those with low incomes. Prices for food, gasoline, and housing have all risen faster than usual. Yeah, so we all know gas has risen, food has risen, but like they haven't risen like the housing market has now in 1 month. That 12 to 14%, depending on how you look at it. And this is in the region, but this is I worked in Hamilton this week, and it's the same thing. So this is not a localized phenomenon. It's a Canadian or Ontario, but it is throughout Canada. I've seen other reports from other places too. So he expects inflation to remain close to 5% throughout the first half of 2022 and whatnot. So predictions, whatever, I take them with a grain of salt. The second time they mention housing or houses is we also assessed more domestic sources of inflationary pressures. While global goods price inflation is expected to ease, the tightness in Canadian labor markets, rising house prices, and evident capacity pressures suggest that if demand continues to grow faster than supply, this will put upward pressure on inflation. So, that's you can take from that what you want. And then lastly, this is the part that I think this is the most important paragraph in this opening statement, because my argument is everything's happening, all these prices are up, food's up significantly, gasoline, vehicles, all goods are up. There's demand out there. Even though the prices are up, there's a big demand, and whether you blame it on global supply chains or whatever you blame it on, and look at house prices. So why not raise them on January 26th? People won't mind, normal people, but I think it's because of the big guys, right? He's doing this. This is not about the little people. This is about the big guys and the big corporations and investment firms that they have to prepare for the shock to the markets. And this is my opinion. I'm not saying it's truth, but that's what I think. Because if you let's read what he says here. We take our communication with Canadians very seriously. For almost 2 years now, we have had told Canadians we would keep our policy rate pinned at its floor until economic slack is absorbed. With slack absorbed more quickly than expected, it is time to remove our extraordinary forward guidance. This ends our emergency policy setting and signals that interest rates will now be on a rising path. This is a significant shift in monetary policy, and we judged that it is the appropriate move forward in a deliberate series of steps. So what I get from that paragraph is, the focus on telling Canadians they would keep their policy rate pinned at its floor until economic slack is absorbed. What's the benefit for the average Canadian to keeping these interest rates pinned to the floor? All it's done is it doesn't help with mortgages and housing markets. The house prices have run rampant, so there's no benefit there. It didn't help with average day-to-day goods for the average Canadian, because all they've done is rise because of inflation. So I think what he meant to say is, for almost 2 years, they have told Canadian investors or his buddies or somebody, because low interest rates don't do justice to the average Canadian throughout this pandemic. All it's done is hurt them. So again, this is, I don't think he's speaking to average Canadians. And he didn't say we've told average Canadians, we told Canadians. Which Canadians? I don't know. But anyway, that's my thoughts. Like it's very a deliberate statement, and it's focused towards certain people, but it doesn't help home buyers, first-time buyers, any of these people. You might think it does. Low interest rates, you can get a good deal on a mortgage, but not when the homes are going up $100,000 in a month. This doesn't help any first-time buyer. It doesn't matter how low the rate is. They could be giving you money. They are giving you money. They could give you, technically the rates are negative when you look at the inflation compared to the rate, but it doesn't help you. But anyway, that's my thoughts on that, and that's just reading between the lines on it. So now, before I get into my skepticism on the stress test, obviously my my title was a sarcastic one, like sometimes it is, where I don't believe the stress test is going to help Canadians in the future when interest rates rise. But let's look at the history. So the stress test was introduced in 2016, and again, this was in the beginning. The stress test was it was introduced in the wrong way and targeted the wrong people. Initially, and you can see here, all insured mortgages must now be stress tested using the 5-year posted rate, qualification rate. This came into effect October 17th, 2016. So what that meant was only people with less than 20% down, so whether it was young families, first-time buyers, 5%, 10%, whatever the case may be, but less than 20% were affected, had to go through the stress test. So investors, to buy an investment property, you needed 20% down. So if you had 20, 30, 50% down, people with money or investors that were taking, maybe they were taking equity out of another home to buy a rental property, you weren't affected. And they realized this after a couple of years. They said, all we did was hurt first-time buyers, and it didn't calm the market. The market was still crazy after that in 2016, 2017. First, actually, I want to go back to the CMHC fee increase. It's not part of the stress test, but CMHC, I just wanted to touch on this because it's something that a lot of people missed or maybe they don't realize. But CMHC in 2017, they increased their premiums, and again, it disproportionately affected the first-time buyers. I think we were at 3.25% prior to this. If you had 5% down, you'd pay 3.25% on your, or it could have been 2.75 to 3.25. I think it was 3.25. But anyway, after this point, you were paying 4% CMHC mortgage insurance with 5% down. So you're putting 5% down on a house, 4% of it you'd have to pay to CMHC. So technically you're putting 1% down. And of course, CMHC did this to protect their book of business in case people default. But that was just an important update in the history of the stress test and the policies I wanted to address. So yeah, they were really protecting themselves by collecting more insurance premiums. So then again in 2018, the stress test got announced, or the announcement to the stress test was it's going to affect everybody. So not just people with less than 20%, but people with more than 20% down. So all mortgages, insured and uninsured mortgages in Canada, were subject to the stress test. So this would even out the playing field because nothing happened when they did the first one where it affected only people with less than 20%. So they figured let's put this across the board, and this will help, qualify. And they were using it for a cooling method at the same time too. It didn't work. Actually, in 2018 they started to drop the rates, and that worked. But they raised them again, or sorry, they raised the rates in 2018, and that worked. And then they dropped them again at the end of the year. But anyway, the stress test really didn't have much of an impact at that point. And yeah, we'll see. It was supposed to protect people from future rate increases, so that when the rates do go up, you're going to have protection in there because you're qualified and you're technically able to afford to pay that higher rate. The next big change was supposed to be in 2020. They announced it, where they were going to tighten up the stress test qualifications a bit and make it a little bit harder. So they're upping the rate. So instead of the previous, I think it was 2% higher than the advertised rate at the bank. And now the advertised rate's always higher than the actual rate you get. So, and it was around 4.75, something like that. You can correct me if I'm wrong in the comments. I'm just kind of generalizing. But now they said now you have to qualify at 2% higher or at 5.25%, whichever is lower. So again, made it a little bit harder, a little bit more stress to deal with when qualifying for a mortgage. And of course, here we are. That didn't happen because of COVID, but then they did introduce it in May of 2021, as you see here. They did increase that and to make it harder on the stress test for everybody. So here we are today. Now, I've heard people and I've heard reports, I've read things that say, You know, when interest rates go up, because they don't want to put interest rates up because they know it's going to have a negative effect on financial markets and housing markets. There's no way it can't, right? It's costs more to borrow money. It's going to come down. Prices are going to come down across the board. Now, some people think they're actually not going to put them up because they're just talking about it, and they have talked about it, and they haven't put them up. But I think we're going to see them go up. So the theory behind the stress test is when they do go up, everyone can afford their mortgages because they've been qualified at a much higher rate, and at 5% or 4.5%, whatever the rate was when they got qualified. And my argument is they didn't factor in the inflation on the rest of the goods when they do this, and they still don't. When you do your stress test, it's just, here's your income, here's your debt, this is how much you can afford out of your total paycheck to pay your mortgage. But people who did this 3, 4, 5 years ago, when these things first came in, now their mortgage is going to come up for renewal, and let's say the interest rates are up 1%, 100 basis points over across the board, and they're going to renew, and they'll say, okay, maybe you've got a little raise, maybe you got your 2% a year or 1% a year raise. It doesn't rise with it. It's not as much as inflation, and of course now you have to pay your mortgage at a higher rate. And if now you have a raise, whatever, it helps a little bit. But what about the rest of the stuff? Did they factor in higher inflation on these calculations? So groceries could be twice as much as they were back then. Cars cost more. Fuel costs more. Everything costs significantly more. So I don't think the stress test is going to be as effective as they say it's going to be, just because they didn't factor in the rest of the inflation on all these other goods. And the cost of living, everyone knows the cost of living, they say it went up 5%, but we all know it's a lot higher than that. And you know, and especially if you're going to go back 3 years, 4 years, we're talking 5% year over year. But things like, you know, groceries, certain groceries have gone up 10%, meat has gone up higher. So you have all these things, and so you have less of your paycheck. So now your paycheck is cut back to paying, you're going to be paying 50-60% of your paycheck now after inflation for this. The reality is, you know, when they talk about interest rates rising and say, well, we did the stress test, so everyone will be okay, or, you know, generally it'll be okay. This is why I disagree with it, because they just, it's one part. It was a very single-minded or simple solution they had to a complex problem that they didn't foresee. So yeah, that's my take on the stress test, or the effects of the stress test, and it's not all it's made out to be, just because of the way the markets and inflation have risen. Thanks for watching, and I hope you enjoyed this video. I will be back soon with another one on the 2022 housing market. I'm going to keep that theme of just like updating what I see, you know, the major things, events as they unfold, major news stories, and just give you my thoughts on it, and hopefully from an industry professional, you can appreciate my take on it, whether you agree or not. But anyway, yeah, thanks for watching, and I will see you next time.